So I want to start off with a story that I've seen quite often as a residential mortgage lender. So we're going to use the name Joe Smith, a potential client that came to us looking to get pre-approved and buy a home. So Joe was self-employed and he'd owned his business for about 10 years and he was pretty successful at it. He'd never owned a home before. And so this was his first time trying to get the pre-approval. So he didn't know what to expect. So his tax preparer had always focused on making sure that his tax liability was the lowest possible. And when we reviewed his tax returns, his income or his net income didn't show enough income to qualify to buy a home. So this is the issue that we find with most of our self-employed clients. So the question is, how can we find the middle ground for self-employed clients to show enough net income to qualify for a home while also maintaining somewhat of a low tax liability? So this whole process starts with their relationship with you all, the financial advisor, CPA, tax preparer. It should be an annual discussion and a question that you ask if they're considering buying a home in the next couple of years. If they are, then we want to shift the focus most likely to maximizing the net income rather than always the tax savings. So some information I want to give you on standard qualification. So on a conventional loan, the standard qualification requires a minimum 2-year history of self-employment and income. So they have to have been in business for at least 2 years and showing income on their tax returns. Then, if that's the case, we basically utilize 2 years of net income and we take an average of that, as long as the income's increasing over year to year. So that's what we look at, and that's how we get the net income that we qualify the client on. So if the client doesn't happen to qualify for a conventional loan, then we have to look at a niche product or a bank statement type product. Usually those products carry higher down payment requirements and much higher interest rates and terms. So I wanted to give you a couple of tips on preparing taxes, and you probably already know this, but I'm going to throw it out there anyway. You can utilize depreciation, or we can utilize depreciation as it's a non-cash item, and we can actually add it back into our income calculation for the client. If they also take an auto mileage deduction, there is some depreciation in there that we can actually add back to their income. Amortization, if it's applicable to your client, can always be added back to income. And then on a Schedule E, if they own rental properties, we can utilize depreciation added back to income as well. And we want to make sure that the client also documents any one-time expenses that are on there, because we may be able to withhold or take those off of the expense section. So we want to document repairs or expenses with receipts and things like that. Always want to show cash flow positive on the rental properties once we add the depreciation back in if possible. So hopefully this information helps start the thought process here towards our future home buying clients. And my team and I at Strongwell Mortgage are always happy to help answer any questions or go over any scenarios with you and your clients. So make sure to follow us on social media for helpful home buyer tips and valuable information. And we look forward to assisting you and your clients in the future. Make it a great day.